Welcome back to our Chapter 7 lecture. We are going to pick up with our illustrations of various depreciation methods. So here we have Ralph Pizza, who ended up buying a Toyota delivery van on January 2nd, 2014 for $13,000. The useful life of the van is 5 years. And at the end of the useful life, we estimate the van's value to be $1,000. So we want to prepare a schedule of depreciation expense per year for the land using the straight line method. I highly recommend you do this in Excel. It would be so much easier. So our depreciable cost is going to be $12,000 and our rate. So basically the depreciable cost, as you'll note, is our $13,000 minus the $1,000 salvage value. And our rate is 1/5, right? And so we're going to multiply that by our annual expense. And then usually in the first year, these are the same. So then all we're going to do is take to get this $10,600. This is our $12,000 minus our annual expense of $2,400. And we continue the cycle, which would be identical for each of the periods. The only difference is now you're going to add, this is the 2,400 here plus this 2,400 is equal to the 4,800. And then our next piece is going to be the 4,800 plus the 2,400 is going to equal our 7,200. And we continue this cycle. Again, the 72 plus the 24 gives us our 96, and we keep here, we are going to keep depreciating. So here we have the 12,000 minus the 4,800, and then here we have the 12,000 minus the 7,200, and we get 3,400, 12,000 minus the 9,600. Book value is your cost minus your accumulated depreciation. And note, in our last year, it should be fully depreciated, but our book value is going to equal our salvage value or our residual value. So if we're doing the same bit of information now for units of production, and we are given that we traveled 15,000 the first year, 30 in the second, 20 in the third, 25,000 miles in the fourth, and 10,000 mile in the fifth year, we're going to have the rate per mile. So basically we're going to take our 13,000, which is our cost, less our residual value over the total units. So we have 12 cents, and then each of the miles is multiplied to get the annual expense, and then that is carried over. And here what we're going to have is the $12,000 minus 1,800. 13,000 minus 1,800, excuse me. And then we just keep going, and we just continue to keep the formulas going as our rates stay the same, our mileage rate per mile stays the same, and then we just keep multiplying it by the differences. Our accumulated depreciation cannot go less than our cost and then our salvage value, right? So we know same thing like before, but now we're just saying that we've depreciated it at 12,000 and it still costs 1,000. And for the double declining balance, our beginning book value, our beginning rate, and remember this is 1 divided by 5 times 2 to get the 40% because we're using 5 years here as well. So we want to just make sure that we go through all these formulas and understand what is happening here. So we're taking the beginning book value, multiplying it by the 40% to get our annual expense. And then that becomes our accumulated depreciation. And then we take our accumulated depreciation minus our cost, and we do that along. And right here, notice that in the last year, we have to be careful because our accumulated depreciation cannot be greater than 12,000. So we end up with a book value of $1,000. So hopefully this helps clarify. Now with this video, you hopefully have your schematic to do your Excel templates. And basically, there's a lot of issues with plant assets. Sometimes they have longer lives. Depreciation does affect income tax because depreciation is an expense, so it reduces your earnings. And then you also have gains and losses when your plant assets are sold and some international changes. So for depreciation, we tend to use any method that is accelerated because that decreases our tax payments, and then that additional money lets us reinvest it in the business. So you'll see that depreciation here is a non-cash expense, and then you can see the more we depreciate, the less our income is, and then the less we have to pay in taxes. So hopefully that just gives you a look at it. And then when you compute depreciation for partial years, in this example here, what we're doing is we purchase a warehouse on April 1st with a 20-year useful life and an $80,000 residual value. So UPS accounting year end is December 31st. So in this case, we need to depreciate it from April through December because we bought it on the 1st. So we have our $500,000, which is our cost, less our residual value. This is our useful life. And here that gives us a full year's depreciation. So in this case, all we're doing is multiplying by the 9/12, right? Because we've basically bought it in April, so we get to do it to that point. So that's the, and you should have that Excel formula in your template as well. So this is just showing you what to do if it is less than a full year. So many managers, what we sometimes do is we want to change the useful life, or you want to change the residual value, because, and the only reason you can change it is because you have new information. You either expect the asset to be available longer, or useful for longer, or useful for later. So when this happens, we basically are accounted for in the period of the change. And then in this case, prior years are not affected because it's called a change in estimate. So all you really have to know here is that if you change some estimate in your depreciation, you do it in the current period, and it'll carry over to the future periods. So here what we have is that we purchased equipment for $510,000, which was estimated to have a useful life of 10 years with a residual value of $10,000. Now depreciation has been recorded for 7 years on a straight line basis. So in year 8, we determine that the total asset's useful life will be 15 years with a residual value of $15,000. And at the end of that time. So our journal entry to correct prior year's depreciation is none. What we have to do is now correct our depreciation for this year. So as you can see, what we had is basically the equipment after 7 years, we had $350,000. So we take that out. And then we have $160,000 left, and that's what we're going to use to say now we have a new residual value of $5,000. So you don't change what happened going forward. This information took place. This is what we had as of December 31st. This does not change. We just take the balance that we had, subtract our new residual value. So now we have $155,000. And our useful remaining life is 8 years, because 8 plus the 7 we did equals the new 15. So now our entry is going to be depreciation expense for our new amount and accumulated depreciation. And you will get practice of this in your homework as well. So for a fully depreciated asset and it has 0 residual value, this is what you will see. You can use the asset continuously, but you just can't record any more expense. So just because an asset is fully depreciated does not mean that it gets out of use. You still use it, your book value is 0, but then when you dispose of it is where you remove. So when you get rid of the asset, you sell it, or you just get rid of it, that's when you go ahead and remove it from the books. And that's where we'll pick up our next lecture.